Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Joining us today is Joe Davis, Global Chief Economist and Head of the Investment Strategy Group at Vanguard, which is the world's second largest asset manager, overseeing $11 trillion as of the end of July. Joe is also the author of a new book called Coming Into View: How AI and Other Megatrends Will Shape Your Investments. And he explores how technology, demographics, and global shifts will redefine the investing landscape. Joe, thank you so much for joining us today.
Oh, thank you for having me. Thrilled.
Let's start with your background. You spent more than 2 decades at Vanguard, a firm that is now celebrating its 50th anniversary. Would you share how Vanguard's mission and approach have evolved during your tenure, and what stands out to you most about your journey there?
What has not changed is the client focus, the mission. It's really the brilliance of Jack Bogle of even our structure as a company. You know, the end investor is the owner, the client owner, and so that's grounded me. It's grounded, I think, my colleagues in terms of the products and services we can provide and our long-term investment philosophy. Now, what will continue to change is, the investment tools at our disposal. When I started in the business over 20 years ago, exchange traded funds, weren't very common, and how we can deliver certain technologies and tools. So I think that will continue to change, and certainly for the better. And other assets that investors can access. Well, what has it is just to focus on the end investor. It's their money. You mentioned 11 trillion. I mean, we're the custodians of capital, but it's certainly it's the client's money.
Well, you mentioned Jack Bogle, and you had the opportunity to spend some time with him before he passed in 2019. What lessons or perspectives did you take away from those interactions?
What perhaps is known, I had the pleasure of meeting Jack Bogle, multiple times through my career, and he even took time, and as I was a new employee, to meet with me. In fact, I talk about it in the intro to the book, just to see where this conversation started. But he was really a master of the human language, a zeal. I mean, I would say a zeal for lowering cost, improving transparency for all investors, whether they're at Vanguard or not. I mean, you could feel the intensity of his beliefs when you met with him, I lead our research group here at Vanguard. He read all the papers. He would find the typos. He pushed me on certain things. We didn't agree on everything exactly, but he always came at it from a researcher and a practitioner. I think he had a wonderful beauty of let's bring some of these great academic ideas into the broad investment domain, and so he remains a tower in the field despite his passing.
And it's pretty amazing because we live in a world where the client should always be first.
Yes.
But it's less common than it probably should be. And 50 years of client first and having that philosophy and it not wavering despite all the growth is very impressive.
Yeah. Well, and again, I think like you do, Alex, and others, the listeners, right, as either the client or the advisor, such an important relationship. I have an advisor in my own life, and I really rely on that trust. And even Vanguard and other asset managers. At the end of the day, if you don't have trust with the client, with the end investor, then it's your business should suffer. And so that's always should be in the front and center. And of course, RIAs and advisors are such an important component of that ecosystem.
So if we go back before Vanguard, what first drew you to economics and investing? And did any seminal moments or early influence set your long-term investing philosophy?
I would like to think I had a plan, but I didn't really. I changed, and I tried to not mention this all the time with my children who are in college, but I changed my major 4 times in my first year alone. And but I was always a learner. I loved math. Economics seemed to really marry some of that statistical and math background with practicality. Try to point that to a practical problem, whether it's social science or physics or whatever have you. And then the fact is, I went right from undergrad to grad school. My dad says I tried to avoid the working world for as long as possible. There's probably an element of truth to that, but I thought about going academia. But when I saw how you could apply economics, particularly in the world of finance, that really resonated with me. And so early work experience pre Vanguard really set me on the path.
I know your book started out as a major research project. What inspired you to research megatrends like AI, demographics, public debts, and from a high level, how did it change your own views on markets?
Yeah. Well, again, I didn't set out to write a book. And as a reader should know, I don't personally make any money if there is if there is any to be made from the book. All the proceeds are donated to charity. I didn't set out to write a book. I started my team and we really started looking at AI in particular over a decade ago. Believe it or not, I was trying to come up to the curve of how important this potentially could be, but particularly the past 3 years, it was actually my own ignorance on certain really good questions from clients, from advisors, and I'll admit that. A client would ask me, or advisor would ask me, "Hey Joe, is AI going to be good or bad?" And they wouldn't define it, by the way. I get it around the Thanksgiving or the dinner table or demographics. The society is aging. How do I think about it over the next several years? We've had globalization and tariff shocks and so forth. And are we in a higher inflation world, let alone our debt levels? And will that impact the bond market? So I would give, what I would hope would be some informed opinion. And I see some good analysis there, but there wasn't really, I thought, at least we hadn't done at Vanguard, a serious effort to try to estimate what the probabilities and magnitudes of these outcomes could be. Technology versus, competing versus these other factors over the next 3 or 5 years. I was somewhat frustrated that we didn't have a really holistic framework. Don't look at it in isolation. Like AI could be transformative, but we also have debt levels that are increasing. Like which one is going to win? And so it was really that led us to, okay, gather data. Can we do this in a serious way? It's an empirical framework, so by definition it has limitations. But I was really proud that we were bringing some data and science, some of that math background, to try to think about what are potential outcomes, and tie that in with the financial markets, right? So let's talk about growth, inflation, stock market, bond market. That was really important to me. And we had a system already, but not in the context of some of these important forces. And I felt compelled then to bring it to a broader audience when I saw what the projections were. Fairly eye opening to me. It changed many of the assumptions that I thought mattered more or less in the economy and how it may impact the financial market. So again, it was eye opening to me. I talk about that openly in the book. But and I got tired of some of the narratives, quite frankly, that I see in the asset management profession. There's opinions, and I was part of that crowd. And I wanted to try to say, can we do better for the end investor? Because if we can talk about probabilities and magnitudes, Alex, then we can talk about risk management of portfolio. We can talk about trade offs, right? Someone may say, hey, we're going to have a currency crisis because our debt levels are high. So, okay, that sounds pretty bad. It's possible potentially, but what's the probability of that outcome? What's the magnitude of the effect, say, on the bond market or the stock market? Now, as advisors, we can think about taking that into our own decision making process and think about things such as asset allocation. That was a 3-year journey for us, but it's opened our eyes and it's changed our view on a certain set of factors.
It's a bit of a contrast from what you described earlier, which is there's a lot of narratives out there. There's a lot of perspectives, but they're not as well informed about financial market history and
Yeah,
data.
yeah.
And it seems like that's a very long project to collect all that data, study the history, look at the relationships, look at what how the present is different from the past, and apply all of that to come up with projections.
It was fairly humbling. I mean, we had to collect that, but as I said, to my parents, if you're going to do something, you're going to do it right, or at least try to. We collected, to what, at least in my knowledge, my understanding, the most data, particularly on the economic side, that exists on around technology and growth and inflation that there exists. I mean, either in private government or academic circles. So but that helped make the system more robust, but bring it into the modern day too. But it was important because technology cycles, particularly big ones like electricity or the computer, they don't come around all the time. And even other big changes in aging of society, demographics, ups and downs. We there have been previous episodes where the world is deglobalized or slowed in its globalization pattern. So we wanted to capture some of those dynamics, but again, move it into the present day because we don't live in the 19th century. There's some important dynamics and shocks that you can capture that are underneath the surface. And that's what this system does. The important thing to me is that it was a data driven framework and it puts all these forces together in one living, breathing system. And it's by doing that that you see some factors matter more than others at different points in time. And they matter for the here and now. What I was shocked to find is that these shocks, they sound like they're long term, like, oh, it'll change growth 10 years from now, but I'll worry about that for my kids or for the next generation. It's like, no, it's affecting the business cycle here and now. And technology and AI, for example, that's having a material impact. So is immigration shocks and globalization shocks through tariffs. That's hitting the economy right now. So it's a near term effect, even though we're trying to look beyond just the next 6 month news cycle. Um, and um, and I respectfully, I think because of those dynamics, it may change how some central banks forecast. I've had a lot of interactions with some really good, really sharp minds, and we're having some of that conversation. And again, I was not looking for this. We were trying to answer some practical problems from the investment financial side, but we uncovered some other things given just our data set and how we've incorporated all these factors.
Well, let's get into it a little bit. Your book argues the status quo of stable growth and stable inflation, which we've had for some time, is unlikely in the decade ahead. What do you think is most misunderstood about this shifting landscape?
Full disclosure, if I fill out these surveys, what will growth be over the next several years or inflation? I mean, just imagine my role, right? I'll call them consensus surveys. And for the United States, for an example, I would say, yeah, 2% growth, 2% inflation, the Fed's goal, generally speaking, or forecast. Other IMF, other central banks, it made a lot of sense to me. And that's what our central tendency would be. What I was surprised to find is that when you look beyond certainly a year and you start looking out 3 years, 4 years, 5 years, as these factors are evolving, both on the positive side, the potential impact of AI, because we've incorporated technology in its three dimensions, its ability to automate, to make us more productive, or to augment our work, as well as unleash new industries. And that's where that data set's really valuable, as well as some of the negative forces, right? The aging of society, we've tied our deficits, our fiscal deficits, and our debt spending to that sort of aging, given Social Security and Medicare, Medicaid. And so it's that push and pull of those two factors, which means dependent upon their relative strength of AI versus or the lack of productivity and some of the lift that we'll need for higher growth, which is where you get the unlikelihood of this balance of 2% growth and 2% inflation. I was not looking for this diagnosis. Like literally, if you would ask me 3 years ago, I'm on record saying, yeah, 2% growth, 2% inflation makes sense. What I was surprised to find is that that's what is most common in the industry. It's actually the least likely outcome because of this tug of war that is emerging in our analytics between on the upside for growth through the AI with some of disruption, along with if it doesn't materialize, it's got to develop more AI and its capabilities and its lift on new industries. If it doesn't, you get more of a lower growth, yet still high interest rates because some of the deficit pressures and modest pressures on our currency. And because of those two competing forces, you can now see where you don't get this 2% growth, 2% inflation. Again, it's possible, but it's less than a 20% probability of happening for a forecast that I think, I don't know, 80, 90% of economists, I think, and again, myself used to be in that camp, used to articulate. So it's a pretty bold economic assessment, but We're not trying to be sensational or grab headlines. It's coming out of our data-driven system.
It sounds like another way to describe this is you have these major forces at play. And maybe in the past you had one at a time, but there's several all occurring at the same time, which raises the probability of outsized outcomes. And so the median case becomes less likely, and you have fatter tails probably on both sides.
I think that's a really good way of putting it for the audience. And again, there's other times you're right when something's dominating and the other ones are kind of just there. Well, yeah, we have a number of factors all moving, and as you well know, they're in the headlines, and so it's important to measure their relative intensity also know how important they are. I'll give you a good example of something that is widely thought of to really drive the economy and markets, but when you put it in a horse race versus these other factors, and there's 15 of them we have, and not just short-term growth and commodity markets. We got globalization, you got debt levels, we got all these things. Demographics, population growth. It's a component of growth. I've seen some say, "Hey, we're going to have fewer workers. We're going to have a higher inflation world." So there's theses articulated that seem to make intuitive sense, but when you put it up on the data, demographics have a very low causal or driving influence on, say, growth or inflation or the stock market for them, even interest rates. And I've seen central banks say we have lower neutral rates because of demographic patterns. Newsflash, weak empirical evidence. And we have a data set that really shows it. And so that's opened our mind. I'm not saying demographics don't matter, but they have to be really large in magnitude. And I talk about that. So let's not overweight it too much in terms of what it may mean or may not mean for the bond market or the stock market. What's not going to be news is things such as technology and how that impacts innovation, productivity, or earnings growth is really the key factor. But you got to count for the other headwinds, and that's certainly what we're doing.
And in some ways, it's easy to predict that the future is going to look like the recent past. And many investors and economists tend to anchor on past patterns and recent history when forming expectations. And sometimes they can underestimate the possibility of major tectonic shifts that take markets by surprise.
And this is a tough exercise, right? And so we have this diagnosis that there's roughly a 60% chance that AI through augmentation, automation, and through new industries will prove to be probably more transformative than the personal computer and the internet, which will lift economic growth. Not everyone will benefit, so we'll get into this, Alex, right? Like, it's not like it's, "Oh, everyone's clapping." There's some disruption when we look at the labor market, and we have some pretty detailed analyses there. Um, but it's pretty important, but then you have to compare that versus where the equity markets are. But again, why I say that 60%, and then there's 30% that AI is still early in its evolution, that if it doesn't accelerate really further, it kind of stalls. And there are historical examples we pick up in our data set that that we use a lot. Social media is a great example. We all use it, but just because we use it doesn't mean it really lifts economic growth in a meaningful way. And we capture those sort of factors. And so it's early, and then if it plateaus, then you got some of these negative headwinds, which will push down some of the expectations for growth, and certainly then it lead to some negative outcomes for the equity market. Where I'm going with it is you have this 60%, roughly 55-60% odds, a little bit better than expected outcomes from an economic perspective. But you got this 30%. I mean, these are non de minimis, fairly meaningful. You mentioned tails, right? Yeah, we're outside of the tail realm. Now, someone will say, what my apology, I mean, in one sense, I apologize to the reader, the audience is, listen, it would be an easier story if all the odds were tilted one way or the other. It's just easier, right? And I get two reactions to our forecast. So those that are skeptical of AI, they're wondering why what I call the deficits dominate the AI disappoint scenario, why that isn't higher. Oh, Joe, it's higher than 30%. When I go to Silicon Valley, so not that far from UX on the West Coast, I get generally the opposite. Though many will say, listen, Joe, we know the probability of AI winning, as I call it, is 100%. Like, why is it not 100%? And so I find myself saying, listen, this is what the data says, and it's not conjecture. It's incorporating the uncertainty, and it's unpacking the assumptions that I think both camps, when they tell these stories, have. And I think they're aware of them, but they are assumptions. And in our system, trying to bring this in a probabilistic way, I think, then let your audience out, let them make their decisions based upon how they weight some of the factors I disclose. Because then they can think about asset allocation, they can think about, risk management. Now we're in the ballpark of risk management, which I started to get excited about in that. But I wish it was just tilted one way or the other. It'd be easier to explain, but that's not what the data and what the projections show.
Of the major forces, are there any that stand out to you in terms of the market materially over discounting or under discounting its potential impact?
All these factors matter, like demographics, globalization, like how information and trade is going across borders. They matter. We even have climate change factors. We don't talk a lot about. I have geopolitical uncertainty factors, not because we can predict it per se, but you got to control for it, and you have shifts there and like world orders. All of these factors matter. What matters more than what I think is commonly known is a certain type of debt and deficits. It's not debt levels per se. I'd be very careful with my words. I am not saying government debt levels do not matter at all. At the end of the day, one has to repay a debt, but it's the deficits and whether or not they are chronic and ongoing, which matters more for the bond market than I think commonly appreciated. They're not at alarming levels, but that can push up expected inflation through our currency pressure. And I think we even saw a little whiff of this year. It's not a surprise earlier this year with Liberation Day and some of the pressures in the bond market. I'm not alarmist. I'm saying there's a dynamic that we pick up there. And then, of course, what's not a surprise is technology. But because we have three dimensions, what I think is, at least what I didn't appreciate fully, is I know there's a lot of concerns around automation in AI and what it'll do to the jobs. However, what I did not appreciate, and I don't think it's known in the economics community, is one of the primary reasons why economic growth for the past 15, 20 years has been low relative to long run history is not demographics per se. It's actually a lack of automation in Europe, parts of China, and the United States. And so we actually, if we want a little bit, greater thrust in the economy and the earnings going forward, I think we're going to need to see some of it, because if we don't have some of that, we're going to run out of people along another dimension. So it's a race between some of these factors, and then of course you have to compare that to where the earnings are across these global markets. We'll get into that. The equity market in the U.S. is already assuming that the AI win scenario has already triumphed. And so there's some downside risk there, but it also presents some I think, exciting investment opportunities, which I did not see when I started this project.
Well, let's talk about growth for a second. So, recent forecasts looking ahead for economic growth haven't meaningfully improved despite advances in productivity enhancing technologies. So, how do you think about that component?
Well, and again, it's going to be the intensity. Well, what has happened and where you get this 1.5, 2% growth forecast, including the Federal Reserve. I'm not picking on them, but they're a widely followed and respected institution. Um, is the assumption that the rate of productivity that we as workers will not meaningfully shift. Now, that's a strong assumption. It's been fairly low and tepid, and it's not just in the United States. So that's the irony. We live in technology is changing all around us, but we're not getting faster from an economic perspective. Um, our system shows why. It's actually a lack of automation in primarily the service sector economy, education, healthcare, finance, business services, law. We're working hard. I'm not saying we're not working hard. What I'm saying is the technologies haven't come around. There hasn't been anything meaningful since the personal computer and the internet. Now, my computer and the data doesn't know exactly where it is, but you can see them show up. Huge positives, then it just kind of slows and it dissipates. So we haven't had a meaningful thrust. But we're looking at real-time signals of investment in capital, labor, and the ROIs at the aggregate level, and it detects when there's changes in the technology landscape. And if you get enough of them in sequence, then you can start to get critical mass, and that's where you can get these lifts. So it's projecting the most likely that in 2 years' time we could be talking about 3% GDP growth in the United States. So it's putting hard numbers on it. And that's despite the fact we don't have more workers coming into the labor force than we have. So that's where, again, demographics is not destiny. It depends on how technology is evolving and how rapid it is. But we're not there yet. Although what I think now the listeners will see with you're starting to hear trillions of dollars in investment. You're starting to hear things. Our system started picking the potential for this 2 years ago, and that has implications for inflation, for interest rates, because you could have higher growth yet not have the high inflation that come with it, because this is not so much demand as related to the potential capacity for the economy. So it's a very non-consensus assessment. I'm not intended to be sensational. I'm trying to give the audience, this is why it is happening. And it effectively is anticipating that artificial intelligence will become what some call a general purpose technology. And so we're seeing the first phase of that through the investment. But where some of the growth impact comes is not us just saving some time through automation. It comes through new industries that emerge. And it shows up in our data set. It shows up, electricity. It shows up during internal combustion engine. It shows up during the transistor after World War II. It shows up, years before the personal computer and internet in our system. And it's crazy. I mean, it starts to see it, but it's not magic. It's pricing off of the labor and capital decisions of CEOs all around the world. But I wish I knew. I see on my computer screen by the year 2028 some of these drags to where the new industries start to become positive. I wish I knew what those new industries were. Certainly, I wish I knew the companies. I could invest in them. I have no idea. I mean, it's. I talk about in the book, like these are maybe industries that it could be, but now I'm speculative, and so I don't like doing that because I'm trying to stay data driven. But it's those aren't here yet. They're not here yet, but it's anticipating that sequence of event because it's looking at past shocks too underneath the surface, and you see them emerge in labor and capital decisions before they show up in GDP. It's what's called the J curve I talk about, right? There's an investments going on before the return on the investment itself, and so it remains to be seen. But that's where the most likely odds tilt for growth. So it's if the risk, the funny thing is the biggest risk to the economic landscape over the next 3 or 4 years is not inflation. It's actually on the growth dimension. On the past year or two, it's been on the opposite. We've had some inflation shocks, right, with tariffs. That'll change in the most likely scenario.
You mentioned companies. Is it possible the greatest beneficiaries of AI are companies not in the current spotlight?
Now, what we can't do is do it at the individual company level. But what we can say is there's components of the equity market, any equity market, you can slice and dice, right? And many do it by size, they do it by growth value, the old Fama French, the great framework, and factor space. And what I was shocked to find is during periods of significant technological change. So if you assume that AI is going to be like past more meaningful technologies, electricity, locomotive, that sort of thing, personal computer. What I was surprised to find and what our system picks up is that there's two phases, loosely speaking, out to the investment cycle. So I have now my investment hat on. And in the first phase, I'll call it roughly 5 to 6 years, but it's not a preset time window, but it's roughly 4 to 5 years. You can think of the late 90s if you're going to pick a period. But it's where the technology, what I call the producers of the technology, do fantastically well. So it is the technology. Let's think of AI. It is spreading. The spending by tech companies and non-technology companies is accelerates. right? Um, you get a huge amount of new entrants into the technology provision space. And those dynamics make it more likely than not that the economy is going to be transformed, that the price is going to come down for that technology, and hence it's going to have that economic payoff. However, that also sets in motion what I found is a pretty powerful rotation of investment outperformance in the second half. And what happens in the second half is that like companies or industries outside of the technology field, whatever that transformative technology is, they start to have stronger returns relative to the other industries that were producing the technology. And in a form of French way, you can think of so-called the value premium, and it happens in the second half. And so one of the eye-opening investment implications of our work is that the more bullish, and I'll say it this way, it may sound provocative, but the data points this way. The more bullish you are on AI, the more you would invest outside of AI in your portfolio. And it's in the back half of that investment cycle. Now you have to give it some time. You have to give it 5 to 7 years. And the intuition is not only do the new entrants reduce the return on investment for the technology producers, not there's some go out of business, not necessarily the big firms. I wouldn't know which ones would anyway. But it's the again, this technology is transforming the economy, right? So I tell audiences, well, if it is true, then what is it doing for the healthcare sector, right? Which has been tough to serve, tough to scale certain effects. What's it doing for financial companies, banks, asset managers? Presumably, this is a transforming technology. It should be lifting earnings capacity, perhaps new business models. I don't know what they are, but that's what you see in past technology. I mean, just think of the early 2000s. Even take the Nasdaq and the massive correction aside, the internet transformed the economy. Some of the best sectors in the second half were not software or internet companies. So there are this historical parallels to this. The timing is where it really gets uncertain. I certainly wouldn't advocate trying to time it, but if I'm thinking about new capital to deploy, I'd say this is one of those few things where whether you go down the AI disappoint scenario or the AI win scenario, that's roughly 85% odds, those two scenarios combined, right? That's a high percentage. It says certain investment strategies, such as overweighting value, will generally benefit in either scenario. That starts to get exciting because now I don't have to pick a side in the projections.
In some ways, all of this kind of ties together because if the technology is truly transformational, almost by definition, it needs to transform beyond just the tech companies. It's the entire global economy.
I think that's what we will see. Now, again, I am not skeptical on the AI front, or at least, I mean, again, this is coming from someone from an economic perspective saying there's a 60% probability. We start approaching 3% GDP growth in the US, and you start to have above consensus economic impacts, 2028, 2029, 2030. So I'm from that sense, I sound like I'm a quote unquote bull with quotes, air quotes. Yet that very economic diagnosis, I am saying, start to move away, not because I'm skeptical of AI, but because of where that second half of the chessboard, where some of those benefits may accrue, at least from a new capital deployment perspective. And someone on the call may have a better sense of, well, I think it's going to have a better ROI on this sector versus that sector. But I think you can think of starting to move a little bit outside of tech, which is again done fantastically well, and could run in 2026. I wouldn't shock me at the all. And but you can start thinking about where to point. So it's both an offensive as well as a defensive strategy, depending upon how you think of AI. That's one of the outcomes of our work. And again, that was something that surprised me. I didn't think about technology and investing this way. It makes sense, at least to me, once I look at the data, but it wasn't evident to me before we started.
You talked about AI. Would you give us some insight into aging demographics, slowing population growth, rising government debt, and how all of that shapes long-term trends in economic growth, inflation, and maybe even the neutral interest rate.
Those are important forces. What will remain a headwind going forward is the fact that you will have fewer workers entering the workforce. There's no doubt about that. Even if we, have a little bit less immigration restrictions in the U.S. in the next several years, the aging of society, which has been well documented for years, will be a headwind for certain industries and certain economic growth, because it is labor supply is a component of GDP growth. I am not debating that, but it explains very little of the movement up and down on any 3, 5, or 7-year basis, and that's what's surprising. So it's part of growth, but the correlation of demographics and aging with future economic outcomes. I showed in the book the correlation is zero actually, and even talk about fun things like. So I'm not saying one wishes for poor demographics. The deficits will have moved the neutral rate of interest up. That was the first real time application of the system. We started using it 2 or 3 years ago. We published that, we disclosed it. It didn't say that it was going to take down the bond market. It just says the neutral short-term rate nominal was roughly 4%, not 2%, which is what at the time was most on market expectations, central bank expectations had been ours, by the way. The structural deficit can raise the so-called neutral borrowing cost. And that's proven to be correct. And it was something that I think helped influence the Federal Reserve, because we had a number of conversations with them. We disclosed this research in the public domain, and it's kind of stayed there since then. And so where we go from here will really depend upon. I don't want to put too much on AI, but it's going to be the big swing factor. The other ones matter, but an order of magnitude is at least 5 to 1 from the AI front over the next 2 or 3 years, and which is probably not going to be drastic news for your listeners. It's just these headwinds haven't gone away. It's just that they can be more than offset for an extended period based upon how these other factors evolve. And in the late 90s was a great one. We had some demographic profiles worsening. We had certain spending commitments, and yet deficits were an issue. In fact, it changed the trajectory of the deficits because we started generating way higher than expected economic growth. So again, back to that status quo changed, and that can matter. There will be headwinds, and again, if AI really disappoints, then you're going to get to this lower economic growth, but yet with an interest rate not drastically high, but won't come down with growth because of deficit spending pictures. And you'll have this tension emerge, I think, stylistically between the Treasury and the Federal Reserve. The Federal Reserve will be trying to keep inflation at bay because structural deficits, can put pressure on the currency. But again, a lot has to happen. You have to take AI out of the system, and that's where you get some of that. Higher higher neutral rate remains high. In fact, if anything, the Federal Reserve in that world has to keep rates a little bit higher than they would wish. But growth now goes from 2 to 1. So we're talking about 1% growth and 3% growth. So the stakes are somewhat high here, and which is why I think about it from an investments point of view, from a risk management perspective, because these are both, I'd call them, they're not sensational outcomes, but they're certainly non-consensus.
Also, disappointment can also relate to timing, meaning the technology could be transformational, productivity enhancing, but it might take longer than people expect.
Yeah, exactly. And I've shared it with a lot of leading minds because I've got trying to get feedback, right? Getting a lot of feedback. The researcher in me, that's what some other leading minds will say. It's like, hey, Joe, I think what you're saying is, or at least some would say, when I've been up in Boston, some great universities there, they say, listen, I think it will. There's no doubt, at least in their mind, that AI will be transformative. It's just the timeline. To your point, Alex, right? Maybe some bottlenecks will emerge on the power side. Maybe just we're being too early in our hope. And I'm just trying to relate to everyone what that assessment is. But being a data driven perspective, it's got to continue to advance. But if it does, in the most likely scenario, because we've quantified these relative magnitudes, let me put it this way. If AI helps through automation and augmentation in the most likely scenarios we're projecting, over the next 5 to 7 years, it's as if the rest of the baby boom, which are retiring right now, we're at peak 65-year-olds in this country, in the United States. It's as if from this day forward for the next 7 years, it's as if none of those workers retire at all. It's worth 16 million workers because we've quantified the hours saved. We've quantified, that would include some job loss. We've incorporated the lift for us as workers, which is a bigger effect. Now, it's not clear a priori which effect will win, the aging of society, your point, or do we get the lift from tech? It's an empirical question. And that's how the projections evolve. So it's as if we don't get a demographic headwind. So AI would come at the right time. That if it was a different point in world history, maybe it would have a different effect. So that's how you can get 3% growth without some of these other factors seeming like they matter. It's just that they're overcome. It's not like they've disappeared from the landscape. But that's the beauty of the system. And this has happened multiple times before. If someone wants a good example of this that I didn't know, I'll give you a year, a number of years. There was a 4-year period in our own history where we had a 90% reduction in the rate of immigration. So it went from 1 million immigrants a year to roughly 100,000 through Congress. We had a material step back in globalization because tariff rates, went up more than 100%. And yet we had an acceleration in economic growth. Now that period was the roaring 1920s. Now, it wasn't that you cheer for a major cutback in population, or you think that tariffs couldn't be disruptive for inflation. They had shocks, but what we remember from that period was really the commercialization of electricity and the internal combustion engine. But what I was surprised that you had these other negative forces which could have determined the 1920s, but that's not what we remember, and that was not the outcome for the stock market. Right. So I'm just using an example where we even pick up in our system. And so it's not that these forces went away. It's just that they were overcome. And so it's trying to ascertain those odds in the same way going forward, knowing that some of these intensities, will be stronger, some will be weaker. And we will continue to update these and disclose them to the public as we go through time.
It's interesting. You mentioned the Roaring Twenties. Obviously, it ended with the Great Depression and kind of the lost decade in stocks for almost 20 years.
Good reminder. I know it's not my intent, but no, it's a fair thing, right? So would that come along? Okay, well, what I'm not saying and what comes out of our system, because it brings into this notion of bubble and euphoria, and we have froth in the financial markets, right? And this is not news. Like I've been on record saying this for 2 or 3 years. Um, and someone could say being early is the same as being wrong. I'm not like pessimistic on our economic assessment. I am not like extremely bearish on the stock market. However, we do have to understand what is priced in versus what is possible. And so where a more muted but positive assessment of stocks, say versus over bonds, is that it's still a positive outlook, but you get lower expected returns, and it's not new. We're picking up these same dynamics that emerged now. What I'm not saying, to your point, Alex, I am not saying that we're in a bubble with AI. It does not get to such an outlier of, say, the 1990s. Earnings growth as an aggregate is stronger than it was back then versus the prices, and so you get an odds of a more muted equity risk premium for the more likely outcome. But it's not like dire. It's not dire. It does tell you that AI better become transformative. If AI is not, then we do have a lost decade in the U.S. stock market, and I disclose that in the book. I provide numbers, but that effectively that means then that AI was completely overrated as a technology. Some may say, in the benefit of hindsight, oh, it was a bubble. I don't use that phrase per se because it implies that technology has no merit. And what we are saying is more likely than not, it does. But it's there, and so that's why it wants to push your asset allocation because of that 30% deficits dominate. it actually wants to push you a little bit into fixed income in a defensive measure because you have such a sort of technology exposure on the other side. So again, there's a lot of eye-opening economic assessment. It's the investment assessments that. And the other thing I'll say real quickly, Alex, since you bring it up, I had clients in Europe ask me last week. They're like, "Hey, with your two tug-of-war scenarios, as I call them, they're like, are you gaining more conviction or less?" I think it's a good question. Now I'm looking at the financial markets to ascertain or odd shift, right? Financial markets reflect a lot of smart people and millions and billions of investors. I think what we're seeing right now, maybe I'm trying to see things that I don't want to see, but I think it is showing that this tug of war is trying to think about these non-consensus outcomes. And why I say that is you have something very unusual in the financial markets. And it could be part speculation, could be whatever, but we have the price of gold going up at the same time as we have, AI and technology stocks going almost supernova. And that's very unusual. But I think, some may point to the gold price as saying, hey, that sounds a little bit like deficits dominate. And then the tech the tech stocks obviously is trying to anticipate really economic lift and transformative ROIs, and so it's not necessarily inconsistent to me that we're seeing that sort of push and pull emerge. The irony is that if you believe in one of those worlds will more likely occur, the signals that are giving you that lens, gold prices and technology stocks, are precisely the investments, although they're a signal, they probably are the underperformer in that world, which is the irony. That's the sort of ironic sort of conclusions you get from the framework.
Well, you've shared your big picture outlook. Let's turn to what investors can do with that perspective. So I want to ask you a few questions about asset allocations. So how should investors think about the diversification benefits of stocks and bonds in an environment where there's inflation uncertainty, growth uncertainty, a potential wide range of outcomes, and potentially more extreme outcomes? How should investors think about diversification?
I think the first thing is obviously stay invested, right? That's may not be new news, but at the end of the day, if we have these long or medium run goals to outperform inflation for spending, whatever it is, next generation, our own retirement, whatever it is, we got to stay invested and capture those risk premiums, those things over the rate of inflation, and the volatility that comes with that territory. That's high quality fixed income and equity of various dimensions. First stop, and our assessment doesn't change that. Now the question is, offensively and defensively. So, from a risk management perspective, how can you think about it going forward? What has been the case is that U.S. stock market in particular has just triumphed over any other benchmark, and that's been wonderful for investors. But where I come with it is, and this is something we said for 2 or 3 years, but it comes to there's a technology rationale and a megatrends rationale for this is I'm strongly underscoring, think about that little diversification. Again, wherever you're at, a little bit outside the US and a little bit outside of tech for the next 5 or 7 years. And it's offensive and it's defensive because technology shows that the fact is that most of the technology generation in this phase one of this cycle have been US based companies. That's great. But the odds of that happening again, it's possible, but I just don't have 100% conviction on it. And so just backing off the zero bound there could have some value for deploying new capital. So I think that's the case. And then on the fixed income side, it gives you a little bit of that. We are not. Our assessment is even if the Fed cuts rates a little bit, but the neutral rate is higher and has been hovering there. You get this higher real return that can give you a little bit of ballast given some of the risk in the markets. That's really the high level what I will be starting a conversation I'd be having with clients.
Yeah, it is interesting because the picture that you're describing is a world in which you have a wide range of outcomes and potentially more extreme outcomes and in the tails. When you look at portfolios in general, they're probably less diversified today than they were a decade ago, right? More equities, more US equities. The US equities are more concentrated in companies that are effectively competing against each other. So there's a lot of concentration in a world where it seems like you want to be more diversified.
listen, if someone's skeptical on AI, this thing is too frothy, March econ. If one has that view or that prior, there's some odds of that from what we do from an economic perspective. That's easy. You want to get out of the Mag 7 a little bit. You're really getting really defensive, and you could even use the word bubble. I'm unprepared to say that. I think what's eye opening to me is that even if you're excited about the future, still pushes you in the same direction, right? Because of what I said before, starts to spread. It's not like, oh, well, the more optimistic you are on the tech front, the more you get pulled up on the equity side. I think there you can think about it from a what's the next chapter to this story. But yeah, I think about, but it's not easy. I would be thinking about, again, like my personal view is deploy new capital, right? Like I am not personally going to be able to if I have a portfolio manager, I am not saying like a significant underweight to technology stocks. I could be writing the long run thesis out. So I'm probably out of a job. Like I'm not making it, right? Because if we're 1996 and not 1999, I got 3 years of chronic underperformance. I'm thinking about risk management and my tolerance for tracking error, for underperformance, and what the client is thinking. So I'd say everything with new capital deploy. Let's start thinking about the second round of AI. Either it doesn't pan out, 30% odds, or no, it does pan out. Now we're talking in the new business framework, new to start thinking about there. And so that's how I would be thinking about it from a new capital perspective. Just given the fact that we have more risk, and it's great. No one's made a mistake here. I'm happy the fact that the U.S. market is up so much. My probability assessment of me retiring has gone up. So I'm more of just thinking about how can we tweak at the margin to preserve and to maybe even continue these gains. It's history shows very clearly that this trend has a finite life to it, and so let's start thinking about how those shifts could occur, and let's start having exposure there to those outcomes.
As investors think about building towards a more balanced allocation, is there a scenario in which assets like gold or even Bitcoin meaningfully improve long term portfolio resilience?
Here's what I would say, whether if one has gold or crypto. Um, And first of all, congratulations if you have a high exposure to it, because the past year or two, I have not. And so you can say at home or wherever you're listening to, hey, well, I'm doing better than you, Joe. I say, well, thank you for. I want to acknowledge that. So, but how do you think about it from an asset allocation perspective? I would say, you start getting beyond 5% allocations. You have four assumptions that in our framework we need to play out to go beyond 5%. Let's say. Right? And I say 5% because almost any asset, you can think about a lottery effect. I want to have some tail exposure. So I would say like a non-de minimis position, Alex. You'd say you're going to go beyond that allocation. You just have, whether you're aware or not, from an economic perspective, I want to just share the beliefs that you have with that. One is AI is not going to be a meaningful transformative technology, right? Because if it is, that'll push you into the AI wins and you're not going down the deficits dominate. Secondly, is alternative stores of value or currencies emerge besides the US dollar, or at least emerge in more meaningful prominence, which means you probably have hoping, whether you realize it or not, the a euro bond market will develop, or the Chinese renminbi will become more open on certain platforms. May happen, but that's the second sort of variant of your thesis. The third one is really the big three. The third one is the Federal Reserve. AI doesn't transform. By the way, the Federal Reserve does nothing to fight any potential inflationary impacts of higher and higher fiscal deficit spending, which, by the way, growth has not lifted, but we haven't done anything on our spending commitments or tax commitments. And so the structural deficit widens in that scenario. And yet you have the Federal Reserve that sees some of that dynamic, but actually keeps policy rates really easy, very possible. If you have all three of those and say, yep, AI is overrated. Oh, B, U.S. dollar, we're going to see more diversification outside the U.S. dollar. And then three, Federal Reserve is going to be weak kneed and they're going to give up on the inflation mandate. If you believe all those three and the conviction in those, then yes, you're going to say, okay, things such as gold or crypto, that'll push you down that path. Because and only under those three assumptions, and it's only a subset of our deficit dominated scenario where those sort of assets really outperform, because now you have a bond market that has gotten, bigger headwind with inflation, which is not the primary outcome in the deficit dominated scenario. And of course, you've had exposure to effectively a lost decade in the US stock market because AI has done effectively nothing and the earnings expectations haven't been met. So I'm not saying that that's not possible. In our system right now, that probability of occurring, effectively what one is saying is we're going to have a possibility of some sort of fiscal crisis over the next 4 or 5 years, and a lost stock market with the AI bust. And if that's, I'm saying in our system, that's roughly a 4 or 5% probability. So if someone asks me unaided awareness, oh, what percentage should I have in gold or crypto? I'd say not naively, well, maybe up to that, because that's the probability of that world emerging. It's not zero, but I'm just telling the audience why it's not 20 or 30%. Now, if some your listener is thinking, well, I believe differently on those probabilities of those outcomes, then your weight's going to go up or down. Um, I'm just trying to say in our framework, that's why you get it. I would also say that if someone has a small allocation to crypto or gold, from an asset allocation perspective, this is going to sound sensational, but I would not be rebalancing to that holding. So I'm saying at Vanguard, don't rebalance to that holding only. And why I say that is two reasons. One is, as you know, Alex, and as your listeners probably know, the reason why you rebalance to an asset is because it has an expected future cash flow over and above the rate of inflation, whether it's a fixed income payment or an earnings and dividend of an equity market. And so you rebalance because there is some average long run expected payoff for each of those things. And so you want to keep the portfolio somewhat in balance, as they move around. With gold or crypto, I would argue, without the low cash flow, that the real equilibrium rate of return is zero. So over and above the rate of inflation. Now, in fair value, I have no idea what the fair value is for those assets. So they could go up. They could go up another 100%. I'm not saying that they won't. But then, from an asset allocation perspective, you would not want to rebalance because even if there's not a long run expected return, because by not rebalancing, you could do two things. You can preserve the potential lottery effect if it pays off. And I'm not saying it will. I'm saying that it's possible because I don't know what the fair value is of gold or crypto. I don't. I don't think anyone on this planet does. But then if you're rebalancing and we don't get that payoff, but it doesn't have a positive real return, I am now rebalancing my 3 or 5% position, assuming you have a positive real return. You are now locking in losses, which haven't occurred yet, but could in the future. So that's how my team and I have been starting to think about crypto or gold. We do not have as a core asset allocation. I am not saying that however, that there's not a state of the world that it couldn't pay off. It could, but you have to think about it, I think, in small doses, and you have to think about it in the portfolio a little counterintuitively because of the nature of the investments. The fact is that they're not throwing off a cash flow, but I am not saying that I know, Joe Davis, what the fair value of that asset is. I don't. I wish I did because it would make it an easier conversation. So hopefully that's helpful. I know it's a long-winded response to your question, Alex, but I think it comes up a lot, and at least giving you unpacking what the assumptions are. And I would just encourage others to walk through that probability assessment of those assumptions. And if you come away with a different assessment than then then that's how you would want to think about it in the portfolio.
Yeah, the takeaway that I have from what you just described is it's a world where there's just so many ways this can ultimately play out that even assets that may not have a long-term expected return above inflation may have a role in portfolios just as a hedge against this wide range of potential outcomes.
Yeah, as a hedge, that's right. But you have to really start getting into and at least unpacking for people why the assumption. So if someone said to me, again, gold or crypto, why I'm hard pressed to get off small weights as a potential is because I just said all these probabilities, and it's a joint probability. I got to add them all up, so you can see where the odds start falling. Now we can still go down that path, or those odds could change, but I'm just trying to unpack this is why AI is a dud. Oh, we have alternative bond markets that are as deep as the United States. Oh, and we have a Federal Reserve that's receded from the inflation fighting battlefield. And they all have to happen at the same time. Yeah, we could. I hope we don't go down that path, but we could go down that path. So it's in one sense, it's a form of insured. What I would be thinking about rather than gold or crypto. And again, full disclosure, I don't own those assets, so people got to know that, right? So, but I'm just trying to, as an asset allocator, right? I'd be thinking more of unhedged fixed income because you get in that world, you get pressure on the US dollar. Again, this is not in the 30 or 60% scenarios of us, but you're going to go deep into the 30% deficit dominating scenario. There's some deeper tails there, just like there's some really positive tails on the upper end of the AI scenario. If you go deep in the tails on the left hand side, I think something you could consider is, and you have this is another reason why our framework pushes you outside the U.S. It's a currency risk and a fiscal risk, and so you would want to have unhedged assets, which I think I would rather tie rather than to gold. I'd rather tie to a cash flow, whether it's unhedged fixed income or it's unhedged equity, which generally is what most people think about in the US, like unhedged equity side. So I would be, it's not the great why you own overseas assets, diversifying currency exposure, but that's why from day one, that has never changed at Vanguard. My team with research, that's why you get off the zero all US stock holding. It's a risk that has materialized in other markets. It has not materialized in the US, but it could. And and of course the challenge is saying what's the probability of that? I'm at least saying in our framework what it is, but for those that are out there, some experts saying they have way higher weights. I'm just trying to unpack. This is the assumptions that they have that's generating those high weights, and I think the listener, hopefully they can just benchmark themselves, and then they'll what will fall out is probably a number, could be zero, could be very small weight. If you get higher weights, you're just going to have to push those assumptions to get a higher weight.
Are there any investment opportunities today that may appear unattractive by recent standards, but could be more interesting for the decade ahead?
What's kind of like evergreen is there's a lot of focus on the private investment side. My team's done research for years. Um, Private equity, got more interest in private credit. Um, I'd say it's rather than the state of the world, like would alternative or private investments do what better in the AI win scenario or the AI disappoint scenario? I think I wouldn't think of it bullish or bearish there. I'd say more of from the alternative space is because there's going to be greater availability. That there's no doubt about that. I would hope the costs come down for some of these vehicles. I'm kind of crossing my fingers that I'm hoping greater transparency in some of these vehicles. But Alex talked about on the show and some other topics. So I would say there, just start thinking about it as just a form of active management. It's not saying you don't do it. I just say, unlike the stock market, I can't own the whole thing. I got to pick the needles in the haystack. I can't own the haystack. It's not necessarily like a bad thing. It really hinges on the manager selection or the mandate selection on the private side. That if you can secure top quartile performance, it's going to show. My team's analytics would show you'll have a meaningful weight in certain investors' portfolios. But it really is a form of active management because I got to get on the top quartile side. If I'm on the bottom quartile, it's suboptimal. I mean, and anyone who's going to argue otherwise, I just to be honest, I just need to have a conversation with them. So that's why, like, I almost say, and I'm going to push this argument a little bit. I've said to some investment committees out, I almost would say I'm going to be a little provocative. I don't even think you should call it an asset class. Now, I'm not saying private assets are not like an asset class, but when people say that, I've seen investment committees do one thing. They'll take private equity as a whole benchmark, and it's smoothed and it's not marked to market every day. And they'll put it in their spreadsheet and they'll do some mean variance allocation. They'll get some number, 20, 25% allocation. My problem with that is, okay, but I can't invest in that time series I put in my spreadsheet. I can invest in the S&P 500 index if that's what I use to compare it to. I can't do it for the others, but that doesn't mean one couldn't have a role. What we do is say, give me the strategy I'm looking at. Because I see investment committees, they'll get 25% and then they do what's so-called fill the buckets with a handful of mandates. Some of them may be top quartile, some of them may be on towards the bottom. And so the implementation on this matters a lot, net a cost. And so I bring that up because that's I know your listeners are thinking about that. I am not saying it can't have a role. We show allocations well north of 10%, um, based upon of assumptions of top quartile. Can you get the cost down for the net? Even when we adjust, we real time adjust the volatility because it is smoothed. But it doesn't mean I from Vanguard not saying it can't have a role. It can have a role, but the implementation matters a lot. It's almost like on the equity side, you can almost remove that conversation in some sense because I can own the ETF and the sort of the index exposure, right? I can't do it for this for the privates. And so I'm betting on the 4% of the companies they're going to identify, private companies, they're going to drive that return. We got to think about it that way. And that's less regime of the world based. Obviously, if AI is overrated, that'll push risk assets down in general. But it's less of a beta argument and it's more of an implementation argument. But I personally, my humble opinion, I don't think that conversation has had enough. The implementation angle. I think we need to have that more of a conversation as a group of investment professionals.
I think one way to describe it is on the public market side, it's you're taking more market risk. On the private market side, because there's more dispersion across the managers, you're taking manager risk and picking the right manager.
Totally. And there's nothing wrong with that. I mean, full disclosure, I have some exposure to some of these assets, from my own account at Vanguard. Nothing to do with product. This has to do with asset allocation problem. I think you're right on it, Alex. I think it's a dispersion, which is why I think it's a form of active management. Dispersion is not necessarily bad. We need dispersion for outperformance. If we're not talking dispersion, I don't know what we're talking about with the higher cost. So I need dispersion, which is why it's always a little bit of a leap of faith. I'm not saying you don't take the leap, and I'm prepared for underperformance. In my the allocation I have, but I think as long as we have that, I too often I hear it on the private side as well. It's an asset class. It's a diversifier. I think that's completely the wrong way to think about it. Diversifier to what? I mean, because of the smooth return, but don't take my comments, and those comments sound a little bit pejorative, so I fault me a culpa. But I'm not saying it doesn't have a role. I'm actually saying it could have a role. Let's think about it from your point, Alex, from a dispersion standpoint, the ability for me to get it from my end client, right? And let's put it on apples to apples playing field. Even when you do all that, you can get in the portfolio. And let's talk about it that way, rather than, oh, it's some smooth return that'll dampen the ride. That's just the wrong way to think about it.
Well, Joe, you've been very generous with your time. I appreciate you sharing your insights, and I look forward to many conversations in the future. Thank you.
Thank you. No, again, I'm a fan of the podcast. I'll be listening to future episodes, and if anyone has any additional views, please let me know, or areas to modify my thinking. I'm always on the lookout because there's a lot of things to keep up with, Alex. A lot of things to keep up with.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.